This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil with Invest Like a Pro, and today we're going to talk about something very important, which is what I would consider to be the 4 cardinal rules, principles of trading. All right, you want to make sure you have these down in your trading plan. I think you're going to need them to be successful. So let's go ahead and get right into this. Just briefly, for anyone who has an interest in learning more about my approach, I would suggest starting with the book. I've got it at a discount right now at rabilstockresearch.com/book. I'm putting it out in an ebook format. So feel free to take a look there. So rule number 1 in terms of trading, in my opinion, is to trade with the trend. Now, I have 2 favorite patterns that I look at, and one is the breakout trade and the other is the pullback trade. But both are basically looking to play the direction of the underlying trend. Now, I'm going to focus on the pullback trade because I think it's easier to determine in advance when you're looking to trade. I think this is the simpler of the 2 type of trade setups, frankly. Even though it seems like a breakout would be very easy, I think it can get a little bit more complicated when we start to look at when to enter and what are the best types of breakouts. But when we come to pullback trades, the underlying trend for me is the 18 on the higher time frame. All right, that is my determining factor if I don't have a rising 18 MA on the higher time frame, I do not have a pullback trade. All right, just that is absolute rule number 1. That is trading with the trend. Now, you could have all the momentum you want. You know, if there's a massive amount of MACD and ADX strength, but if a higher time frame 18 is flat or declining and you're trying to go long, you are fighting the trend. All right, so rule number 1 is trade with the trend. Now I'm going to show you on the CCJ. The interesting thing is, so I highlighted this, and I really felt like this was in my reports. I really felt like this was a monthly, weekly setup. And I did it right about here. And the reason is because we were pulling back to a rising 18. It had formed this long sideways consolidation pattern. And then on this time frame, we had this low ADX condition and it started to emerge, made a nice higher pivot low. It was in the process of forming a higher pivot low as it was breaking through this this sort of downtrend line. That was in place. So that was the monthly, weekly version. But then you could look at it on the weekly chart and say, you know what? I've got a rising 18 week. Okay, look at the momentum behind this move as this was breaking out and forming a pinch play. All right, so but the underlying trend for me, higher time frame now, is the weekly has a rising 18. I know that qualifies, right? It doesn't mean that if it has a rising 18, it's automatically a trade, but without that, it's not a trade for me. All right, now if we go and look at what took place, we had this little pinch, and that was this consolidation. I'm sorry, let's go back. It was actually further back. Back here, when this was consolidating, we started to turn up on this time frame. So we had a pullback. A pullback on the weekly chart, and with a rising 18. Now, you could actually look at the most recent pullback on the daily chart as a trade off the daily. That's the higher time frame, and then you could go to the hourly and you could get an entry off the hourly. So every one of these time frames, all 3, monthly, weekly, and daily, provided a trade with the trend. If I'm using the 18. Now, if you look at the underlying strength and the momentum, they confirmed as well. All right, now rule number 2 is limit your losses, cut your losses short, is basically the phrase that's out there. Cut your losses short. All right, and what that really means, I used to think that what it meant was if you enter a trade and you buy this, let's say you buy this pullback and you're getting in and your stop is here initially, that you don't want to lose the full amount. right? You want to try and lose less than what your stop is. That would be cutting your losses short, right? So instead of losing the full amount, I'm actually going to lose maybe half of that or something like that by staying on top of it and watching it close. But that is not actually the case, all right? When you're looking to cut losses short, that just means honor your stop. Now, if you think about this, if this is one risk unit here, the distance between my entry and my stop is one risk unit, or what we call 1R, all right? If that's 1R, then all I need is for this to go beyond 1R and I've made more money than I've risked, okay? Now, rule number 3 essentially goes into letting your profits run, all right? If you've got a stop loss here, you want to figure out a way to capitalize and let your trade continue to carry to the upside. So if I'm in this trade off of the weekly trend and I'm looking at it on a daily, I need to have an approach that allows me to cut my losses short if the trend shifts back down. All right, that's cutting losses short. That's honoring your stop. All right, and risking 1R and not, well, it hits my stop and I decide, maybe I'll let it go and see what happens, see if it'll come back. That's not honoring your stop, and that's not cutting your losses short. So the next piece of evidence that we need is that we have a good trading plan is we need to have the ability. I think 2 things. Number 1 is you do want to pay yourself as the money becomes available, meaning as the market makes money available to you, you do want to pay yourself. But at the same time, you have to give yourself an opportunity to make more money than what you risked. All right. And I would say your minimum criteria has to be 1.5 times what you're risking, 1.5. All right. So if I'm risking $500, on average, I need to make about $750 on average per trade to have a decent approach to the market. So if I'm risking $500 and I'm consistently making $200, that is not an ideal situation. You're not letting your profits run. All right. Now, you can do it in a combo fashion. You can say, I can take a piece of my trade off at a specific level. Let's say at 1R, you could take a quarter off or something like that, or a third. It really kind of depends how you want to handle it and what kind of a trade it is and how strong it is. But you want to make sure that you're giving yourself the ability to make more money than you risk. That is what we call letting profits run. Now, there's a really key thing about this. If you're swing trading, all right, and you're trading short term, then the mentality has to be a little bit different. Then if you're trading off of an hourly and you're looking to get in and out over the course of the next few days, I think what you need to do is you need to be a little bit more proactive when it comes to a stock that's not working for you, because in that situation you actually are trying to lose less than 1R, because what you're going to do on the upside is when you see expansion to the upside, you're going to just sell. You're not going to trail a stop and try and make a whole bunch of money over the course of the next month or something like that. You're trying to get in and get out. In many cases, it's 2 to 5 days. And there are times when it doesn't get crazy to the upside where you could be in it for as many as 10 days. But for the most part, it's going to be somewhere around 2 to 5 days. You're going to get in, and hopefully if your entry's good, you'll get some expansion right after you get in, and you can exit right after that. And I'm talking about exiting the whole position. So if you're going to do that, you're not always going to be able to get 2 times what you risk or 3 times what you risk. And so what you're going to want to do is actually limit your losses to less than 1R sometimes, not always, but sometimes if it's not acting right. So let's say you buy this higher pivot low right here and you have a stop down here. All right. If this thing turns around and gives a big red bar right here, we're talking about a trade that's only going to last a day or two, and you just gave up a monster red bar here. It didn't hit your stop yet. Okay, cut your loss here. Cut it here. So it's a slightly different strategy when it comes to swing trading. I think you have to be, and this is why I say you gotta have more time if you're going to be a swing trader. I think is you have to watch the hourly bars. And this is the way I do it. Not everyone does it this way. Some guys will go by a daily chart and look at what's happening, and they might look at it into the close. So let's say you had a green bar here, and then by the end of the bar, it gives up more than 50% of that bar. Well, that might be a reason to sell if you're swing trading and you're just looking at the daily chart. You could do it that way, but I usually am on the hourly looking for monster red bars, and if they show up, and especially early on in the trade where it doesn't look like I've got any real room here, I'm probably going to cut that quickly. If I get into the loss camp with signs of weakness and I can cut that risk in half or something like that, then I'm probably gonna do that, because there's another bust coming in 20 minutes. I don't need to make money on every single trade. I can go find another one. If I can limit the loss on this, and let's say instead of losing 500, I lose 200, well, that's a pretty big advantage. All right, so far we have covered trading with the trend as rule number one. All right, trading with the trend. And for me, the trend is defined by the higher time frame 18. All right. Rule number two is cutting your losses short. And what I want to make sure you understand about that is that just means honor your stop. You don't have to lose less than 1R. You need to make sure that you average 1R or less. All right. And if you can do that, and that's what my suggestion would be. Now, every now and again, you're going to have a stock gap on you and you just can't avoid it. And that's okay. But we're talking about a mental strategy here, not something that's out of your control, but what's in your control. All right, so that's rule number two. Rule number three is letting your profits run. You have to have a strategy that allows you to get in something that will give you more profits than what you're risking. All right, and I say the absolute minimum criteria is 1.5 to 1 when you put on a trade. I prefer obviously 2 to 1 in most instances, but if you do 1.5 to 1, the numbers will work for you if you're trading with your trend and you're honoring your stops and you're keeping your losses small. You can pull that off, but typically we're looking for 2 or 3 times that, 2 or 3 times your risk. Now, rule number 4 is managing risk. Okay, now there's so many ways you could manage risk. Now, number one, Ray, is from a psychological standpoint, is following all 3 of the first rules. All right, that's kind of a top priority. But a second, there's other ways you can do this. Now, number one is you can risk if you're going to take a trade. So let's just say we put this trade on here after it's breaking out of this. Coming off of this 18-month with really strong momentum characteristics, makes its higher low, gives us a little pinch play, and I put this trade on. So what I'm going to do here is I'm going to risk 1% of my account. And that doesn't mean if I have a $100,000 account that I'm putting $1,000 into the trade. What I'm doing is figuring out my entry and figuring out my stop. What's the difference between those 2 levels? All right, figuring out that number and then risking 1% to that number. All right, I'm going to risk 1% of my equity. Now, if you do that, so on $100,000, you're risking $1,000. Now, you might put $10,000 worth of stock on the trade and then risk about 10%, and that comes out to 1%. Do you see what I mean? That's how the numbers will work. Now, it's not going to be exactly that way, and I wouldn't do it exactly that way. I would probably do it based on the stock's own volatility, but you want to come out at about that. Somewhere around the 1% will come out in that way, where you're risking about 1/10 of the account in the stock. You're putting about a 1/10 of the account in the stock, and then you're taking about a 10% risk if you're doing it off these longer term trades. Now, if you do it off the weekly and the daily, you still want to risk 1%. But you're going to risk less than that trade because you're doing it off the daily volatility, not the weekly. All right. Now you got to figure out the numbers, but the same concept holds true. And then the same thing holds true with a daily and an hourly. Now, my suggestion is if you're going to do a lot of swing trading, I would not risk 1% of your account. I would be somewhere around 0.5% to 0.75% at the max. All right. If you're going to be doing a lot of swing trading by default means you're going to be a lot more active. So you don't want to, and the reality is you won't be able to afford having very many trades on if you risk 1%. 5% of your equity. All right, so that's one way. Now, there's another way to do it is you could say CCJ is a uranium stock. Okay, now if I have your UU, all right, or UEC, I can't keep putting one uranium stock after another and just adding all those. You have to limit it by sector and by industry group in certain cases. I typically do it by sector, but you can do it by industry group when there's a lot of diversity inside the sector. So like uranium probably trades pretty independent of other stocks like steel and aluminum or something like that. So you could play it by industry group if you want, but I would tell you is you don't want to risk in any sector any more than 5%, and I typically like to keep it closer to 3. Having 3% of open risk at any sector is a little too much. And then if you're looking at the whole account, you might want to keep your portfolio risk at around 10% max. So if you think about it, you have 10 stocks you're trading, you have 1% risk in each, and that's about 10%. That to me is a pretty good framework. Now, it's not going to work out exactly that way, but it's going to give you a pretty good framework to start from. Sometimes it might be a little bit more than that, and sometimes in the environment we're in where it's a bear market or there's a lot of volatility in place and the ATR is going through the roof in the S&P, in that situation, I probably want to have less risk on it. Probably want to be down in less than 5%, 5% or less. So you can make those adjustments and that can be a part of your trading plan. But these are all ways to manage risk. So keep these 4 things in mind. Trade with the trend, honor your stop or limit your losses, however you want to think about it. And number 3 is let your profits run. Have a strategy that allows you to let your profits run while also paying yourself along the way. That's my feeling, all right? And then number 4 is managing risk. And there are a number of different ways that we've covered here that you can do that. All right, let me know if you have any questions. Thanks.